Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy. UK firms reported a fall in business activity for the fourth month in a row last week, likely confirming what many of us suspect, namely that the UK economy is probably now in recession. Add to this inflation a 40-year high of 11% and industrial action across the public sector, and it's easy to become a permabear on all UK assets. But there is some light, albeit dim, at the end of the tunnel. Sterling has climbed sharply and gilt yields have rallied dramatically since the trust-squatting fiscal fiasco on September 23rd. The UK unemployment rate of just 3.6 is among the very lowest in Europe, while both electricity and gas prices have moderated at last. We even got a pat on the back from the IMF's managing director for Chancellor Hunt's last budget. While we are determinedly global investors at Saracen, the outlook for the UK is still critical to our clients, particularly in its implications for sterling. So if we're now in recession, how steep will it be? Have our funding costs been permanently damaged? And what is the likely duration of the cost of living squeeze? We'll look at these questions in more detail and what they mean for your portfolio in the slides ahead. So let's begin with our regular review of world financial markets in the left-hand panel, and you can see to the right of that dotted line the performance for Q3 to date. Quite a useful rally across all asset classes. In dark blue, world equities rallying particularly strongly, up 5% in sterling, almost 13% in US dollars. You can see that another way on the right-hand panel. That's the US dollar index, which has rallied so strongly in the aftermath of the Russia-Ukraine war, now beginning to peak in September with quite a material rollover. That's important. Why? It's good for US earnings, it's good for foreign financial markets, and it's particularly good for foreign and emerging market borrowers. So against this slightly more benign investment backdrop, where does the UK sit? Well, UK inflation continues to rise at 11.1%, a 63-year high. That's probably, in our view, at or very close to the peak. That's putting enormous pressure on consumers. You can see that UK consumer confidence at -44 is close to all-time lows, although you'll note a small rally following the autumn statement. In the right-hand panel, what does this mean for the UK recession? Well, the Resolution Foundation have usefully plotted the last 5 UK recessions in dark blue in terms of GDP drawdown peak to trough, and what this means for the recession going forward in the next year on projections from the OBR in green and the Bank of England to the far right in green. The OBR number shows a drawdown of 2% of GDP. That compares to almost 6% of GDP in 2008-09. So yes, a recession, but probably a mild one. So what does this mean for government policy and central bank interest rate outlook? Well, the particular pressure that Sunak and Hunt are facing today is a surge in debt interest costs. Why is this occurring? Well, we borrowed a huge amount more during COVID, and of course interest rates and gilt yields have risen around the world. On some figures, the OBR numbers in dark blue being included, this suggests that interest rates as a percentage of GDP, debt interest rates as a percentage of GDP, could rise to somewhere near a 70-year high. I think Sunak and Hunt have been very good here. The credibility of the autumn statement, the credibility of their own statements, the words of support from the IMF have all contributed to a sharp rally in gilts and so lower borrowing costs. On the right-hand side, you can see since the mini-budget, a 140 basis point fall in gilt yields to 3.11. Corporate borrowing in the UK for investment-grade companies coming down from nearly 7% to 5.3%, and of course a really useful rally in the pound from 107 to 121. Let's now look at spending forecasts, and here the Chancellor's been quite cute. I've shown in the left-hand panel public sector net borrowing in black, that huge surge being COVID spending, and you can see in dark blue the projections going forward. Initially these are actually loosened as the energy price subsidy and of course extra spending on the National Health Service and tax cuts which are delayed to 25-26 actually see spending and borrowing increase. That's useful, of course, in the run-up to a 2024 election. Following that, they tighten quite dramatically and take us down to a credible number by 27-28. The implications for inflation, well, of course, this is critical in terms of what the outlook is for fuel, oil and electricity prices. But if they remain about stable, those inflation numbers start to come down quite fast. round about 7% on average in 2023, and then as you can see, there's red, blue, green and yellow bars reverse, that's gas, fuel oils and other tradables, go negative. It actually pulls the headline rate below zero. Thirdly and finally, we need to look at the labour market, and I'm afraid here the news is pretty grim. On the right hand side you can see working days lost due to strike action and that sharp upward peak in the blue line. That's likely to climb far further higher in the new year and may reach some of the levels we saw back in the 2000s. What's causing it? Well, I'm afraid the message is very clear. Household average disposable incomes are simply not rising. On projections from the ONS and the OBR, it could be that we have 19 years of no cumulative wage growth for the average UK worker. And you can see the pressure that's putting on industrial action. What can governments do? Well, not much to fund in the short term. There's too much pressure on the budget. But in the medium term, productivity is absolutely key, and that probably means closer trading relations with the EU to get that friction down. So what does this mean in summary? Well, in UK bond markets we haven't moved up yet in gilts, but we did buy substantially more corporate bonds in the aftermath of the budget chaos. That's been a useful addition to portfolios. In equities, though we're a global house, we tend at the moment to be overweight the UK, liking some of the defensive sectors, the dollar earners, and particularly the premium yields we can get. Finally, of course, sterling is uniquely important to us. We do hedge some of our foreign currency exposure, and this has been painful in 2022. The rally in the pound in the last few months, though, has reversed this substantially, and I think our positioning versus peers is looking well set today. So I hope that's useful. I hope it gives you an indication of the outlook and trajectory for UK growth and the implications of global assets from a UK perspective. Thank you.